All right, cool. Welcome back to the REI Diamond Show. Reed Goossens, how you doing today?
G'day, mate. Thanks for having me on the show.
Yeah, for sure. So, for context for listeners who may not have been here back in 2018, you are a returning guest, and our topic was raising $9.5 million with a projected profit of over 10 million. And so, I guess we'll start there with a little bit of an update of how that went. Did the deal close, and like whereabouts are you in that deal, Reed?
Yeah, so you said 2018? So that would
I
have
think it was
been
18. Yeah, maybe.
okay.
Yeah.
Yeah, I'm trying to think because I remember the deals by the equity raises. So
Okay. All right.
that would have been, I think, deal number 3, and we're at deal number
Nice.
12 now. So it's completely blown up, obviously in a good way. That specific deal is going great. One thing I will probably, just to look back on, if I could go back in time, would be don't do fixed rate interest rates because interest rates are now really low.
Mm,
We did back in 2000, and I think it was early 2018. It would have been a 4.5-ish 10-year Treasury Freddie Mac loan. Yeah, I should have got floating. So lesson learnt, but you make the decision in real time, and yeah, for all those people out there, don't be afraid of the agency floaters because they're good product. But I remember back at the time, I was sort of being newer into only being 3 deals in, saying, for our investors, let's just cap it and let's just do a fixed rate for 10 years and get 5 years interest only, which was still a really good deal. But just looking at where interest rates are today, you're like, wow, I could be making a lot more cash flow. So yeah.
yeah, true enough. But does the interest rate fluctuation taken on now create a larger risk profile that I'm sure you had in mind when you were calculating risk on the previous deals? I mean, would that be the same wise move today or locking in the low interest rate now? Like, how much lower can they go?
Exactly, 100%. Like if you can lock in at 3% today, yeah, for sure. Like definitely lock in and go for 10. That's 100%. It's just that I didn't back then. I thought interest rates were going higher, and so I think it was 4.35% or whatever it was, whatever we locked it in. I thought they were going to 6. I didn't think they'll be going back down to 3. So, hindsight 2020. You can only do what you can see in front of you right then and there, and we thought it was the best thing for the deal, and it still is the best thing for the deal. We've just executed on a $2.2 million a supplemental loan on that deal because it was a Freddie deal. You can go back and it kind of acts like a refi, but we went in with such low leverage that we went and got more money out of the deal to keep going with that capital expenditure, and it's 5 years interest only. So we're really happy where the deal is sitting today, and we'll be in the portfolio for at least another 3 to 4 years. So still got some time on it.
Nice, nice. Yeah, I was listening to a multifamily investing podcast the other day, and one of the members that was, or the guest on the show, I can't remember which show it was, had 4 or 5 thousand units. He sounded like he was probably in his late 60s or early 70s, so he had this
Mm-hmm.
nice solid multifamily career. And he was looking back, and he said that around the area now, from what he's hearing, like the big names, Blackstone and these private equity Wall Street types, they're not afraid of the floating rates. They don't
Mm.
think that rate risk is going to be a realistic threat. Certainly, at any point in time in the 5, 7, or 10-year term that these big smart money investors are
Wow.
supposed to be doing business. So he kind of shared the same sentiment as you, and just didn't view that as much of a risk. I mean, who knows who's right?
Exactly.
So 12 deals in. What is your exit strategy? You end up selling these at any point? Have you sold any of the deals that you've done, or are you still in hold periods on everything?
No, good question. So we started our first deals were in 2000, end of 2016, early 2017. I'd been involved in multifamily as a co-GP prior to that. So, probably 2 or 3 years prior to that, early 2014, I got started, but I really started my own shop at the end of 2016. So I've been into the 8 years in the syndication space. And then in terms of your exit strategies, yes, we're actually coming to exit a couple of deals right now. And they're the deals that have the most flexibility on the debt, right? So the deal we just spoke about that I was speaking to you back previously in 2018, I can't exit that deal because I'm going to have a big prepay, right? Unless someone wants to come and assume the deal. But the deal isn't sucking wind by any means. It's making money for my investors, making cash flow. So just keep it. We'll write out the prepay. But we have another two sets of deals that were bought as a portfolio, and we have to book bridge on those deals. And we've had them for about 2 years, 2.5 years now. And we are we sort of popped our head up thinking, okay, we can refi here or we can sell. And we popped our head up and did a bit of an off-market type of shop around, and we got the number we wanted to hit, and for this time period to give a pretty solid return for investors. And we decided to execute on the sale. If no one had taken bit at the number we wanted, then we would have gone for a refi. But the opportunity to exit at multiple points along the deal is exactly what we assess every single day, or not every single day, but on a very consistent basis to understand where the market's at, and particularly with cap rates compressing as interest rates continue to go lower. That's you're seeing that shockwave across the country in terms of multifamily, particularly in our area of Central Texas. So yeah, we constantly look at what is the best opportunity to exit for investors, and a little bit selfishly, we as a company, myself, my business partner Andrew, and I, as we're growing to 12 and hopefully going to go double the portfolio in the next 3 to 5 years, people are starting to ask, where's your skins on the wall? Where are your runs on the board? And that's where you got to start pointing to cycle deals and how did it go? What was the returns? And we're really happy to say that we are finally coming to the first set of deals that are selling and got to make a nice, healthy little profit for all our investors involved.
Nice. I'm always curious. I do a lot of single family. And when I got in the single family business in 2006, there was all mom and pop localized investors. And then 2008, 9, and 10 came, and we saw the Blackstones and Cerberus and a lot of these big funds put together a lot of money. You have Divvy Homes out here, and there's this trend toward institutionalization of single family homes. And these are typically kind of the scattershot, very difficult to manage, very difficult to roll up assets, single family, which is a lot of the reason that a lot of people will gravitate toward the larger 100, 200, 300,000 unit apartment complexes. So I'm curious, is the same trend occurring in multifamily where perhaps the buyers for your stabilized asset at this new profit level, I mean, are these institutional buyers or are these entrepreneurial funded buyers just like yourself, who it's, 4, 5, 6 partners cobbled together a team and then put together 12 or hopefully 24 deals in the course of the next 3 to 5 years? Who are the buyers,
Yeah,
basically?
good question. So I think to answer that question, you have to also look at what you just said, the historical trend of institutional Wall Street money looking at real estate as an alternative asset. I wholeheartedly believe, and I do a lot of these podcasts, that real estate, it ain't an alternative asset anymore. And part of the reason, particularly in commercial, you're seeing a lot of this compression in the cap rate because it is a physical asset. You do have the scalability of it in terms of buying 1,000 units, and you don't have to have 1,000 different individual roofs or 1,000 different individual foundations that you got to deal with in the single family space, which is what Blackstone and BlackRock and Blackfish and whoever Black something else, whatever, what those guys probably saw back in 2008, 2009 was that management piece was really, really tough. But in the commercial side, multifamily, as we've continued to be a nation of renters, as the wage increases are pretty much remaining stagnant, as affordability continues to go up and continues to become an issue, multifamily is still a really, really attractive vehicle for living and also for investing, even with compressing cap rates. So I do think a lot of institutional dollars in the last 8 to 10 years have started to really, really big players in the game. To answer your question of the buy-in pool, yeah, we're actually selling to a group that is more entrepreneurial like we are, because we've actually left meat on the bone. We're only 2.5 years into our business plan, and we have the flexibility of selling right now. We've only done 30% of the units, but we've completely done the exterior. We've done the leasing center. We've done the clubhouse. We've done the gardens. We've rebranded it. We've done the whole heavy lift, but we've only done 30% of the units. So there's still more meat there that someone else can come along and execute, right? And for us as a seller, we can sell a value add with meat on the bone at a lower cap rate than I can sell it as a stabilized deal if I'd done 100% of the units. So for us, we're getting a better bang for our buck by selling it with a bit of meat on the bone rather than going and trying to do with 100 units or the 100% of the units and then sell it at like a 5 cap or a 5.5 cap. So, yeah.
Gotcha. And would the institutional buyers say be a better fit of a buyer at the end when 100% of the units are updated. It's stabilized a product with market rents versus any of this entrepreneurial having to finish the renovations. It's more
Yeah,
passive for the institutional investor at that latter point. I think, right?
yeah, look, the tricky little secret here is that after 5 to 7 years, it's a value add for anyone else who wants to come along, because
True enough.
those original rehabs you've done, they're probably 7 years old now. They need a lift
Yeah.
anyway. So
Yeah.
there's always going to be value add. To your point of institutions, they don't like to do a lot of hard work, so they're going to go and probably buy your more 2000 builds, 2010 builds. And that's what we're currently starting to look at now. We don't want to look at the 80s product anymore because it
Hmm.
is really old.
Mhm.
Not that we won't entertain it. It's just that we know from experience that there's a lot more skeletons in the closet. They're coming up to 40 years of age. There's a bigger, I can buy, if I'm buying a 4.5 cap on an 80s product, or I can buy a 5 cap at a 2000 product, I'm going to buy a 2000 product. You know what I mean?
Yeah,
Because
absolutely.
even though it's more stabilized, I might not have as much meat on the bone. I have less risk, and I can still make a really nice spread between where interest rates are, and hold it for a little bit longer. So instead of a 5-year hold, maybe hold it for a 7 or 8 year hold, and get a bit of that value add towards the tail end, because the units will then start to be old. But I'd rather do that than go and buy a 1980s asset, which have boiler systems and really old roofs, and issues that we are now seeing we spoke a little bit offline before we started recording, what's happening in Texas right now with the snow. So these assets that are built, we've got some newer assets in our portfolio that are faring just fine, but the older assets that were built in the 80s aren't going so well. So it's all sort of swings and roundabouts. And for me, as we progress and we get old, we move further down the line. A thing that was built in 2000 or the late 90s is now going to be a value add for me as a buyer, and thus is going to be, I've got some meat left on the bone, and some more juice to squeeze out of that rock.
Yeah, it's funny. I'm laughing because I have the single family thing. That's our space, and we see Atlanta specifically. We're in Atlanta, Chicago, and Philadelphia. Atlanta has the fund buyers, the Blackstones, this one, that one. They're buying there. That's almost the same kind of. It's not quite as new as you're describing, where it's built in the 2000s, but stuff that's built in the 2000s, that's hot fund product. Stuff that's built in the 90s,
Mm-hmm.
still pretty hot fund product. Stuff in the 50s or 60s, some of the funds will touch it, but most of them have a buy box that has to fit, or
Yep.
they take a pass. And I laugh because I buy, like, small multifamily stuff for my own portfolio. And I bought an 8 unit building that's probably built in like 1920 or 1930.
Yeah.
I'm thinking, man, it would be great to have something built in the 90s. And we did the roof last year, and the roof had, I don't know, 6 to 8 inches worth of
Wow.
layers on top. They just kept going, going, going. And we had a lot of snow here. I think 45 inches in the Chicago market, literally. And I was thinking to myself, I am so happy that it was like a $60,000 roof. I'm
Wow.
happy I didn't cheap out on the roof, and they could have put a layer over top. But the guy's like, look, man, this is going to get really heavy if there's snow. And literally, I mean, it's all over the news in Chicago that roofs are caving in on people left and right because you got,
Yeah.
now
The
30 inches.
weight.
Yeah, exactly. But what we're seeing in Texas is blowing my mind. And so maybe you want to kind of touch on that. I'm sure everyone has seen it in the news. Frozen pipes.
Mm-hmm.
The region is just not engineered for the type of weather that has come
Nope.
through there. And you
Nope.
own and are bullish on the Texas market, and so you have this real boots on the ground, real world experience. Why don't you just talk about that for a few moments here, Reed?
And I want to also add that Texas as well is, you don't find as many 1920s product like you do in, say, the Chicagos or the New Yorks or the Bostons, where these really historically older cities, Texas is relatively, I wouldn't say newer, but the large multifamily the boom was really in the 70s, right? 70s and 80s. That's when a lot of construction was down there, the garden style apartments. And to be honest, they were built okay, but they weren't built for snow. They weren't built to weather. They weren't weatherizing, or winterizing, I should say. Pipes under the ground. They weren't digging 4 feet down to get below the frost line to
Mm,
build your pipes. So there's just little things like that are just. And then on top of that, you've got an infrastructure system, like, because I figured out that Texas is on its own power grid. It's unlike the
apparently,
rest of
yeah.
the country, and that's ain't weatherized either, or winterized either. So that's causing a lot of issues. I know the newer build product we've got is faring better. just because the building codes have come up to speed. But the 1980s product isn't faring as well because of, one, the age, but two, the way they built it back in the day. So to answer your question, yeah, it's a little bit. I'm flying down on Sunday to assess the damage. I've got a call here in 45 minutes to sort of go over what's happened. I think, touch on wood, our 2,500 units are going. We've got a handful, 20 to 40 units that are going to be issues, but we'll get that covered by insurance. But I've heard people, whole buildings burned down because people had nowhere to warm themselves, and they're starting fires in their living room. There's just dumb stuff like that. So hopefully we don't have any of that. I have heard the electricity's come back on at all our properties, which is good. Water's still a little bit of an issue in Austin. But I've heard people boiling snow. I've heard we had to hire a bus on one of our assets to just sit on site, and so people could walk inside the bus and keep warm, overnight, because they were without power for nearly 5 days. So it's a little bit, for someone living in Chicago or New York or Boston, you're laughing, right? But when you literally aren't set up for it, and potentially, there's some blame on the state level that they should have done some more to weatherize their infrastructure, but until you're sort of living it, you can't really say, oh, hindsight 2020 again. You're like, oh, I should have done that. But maybe it will put them in, the way people are built now moving forward will be completely different to how they were building over the last 20 or 30 years. So to answer your question, we're still sort of in the thick of it, but I think we'll get out of it okay. I'll see next week when I finally get boots on the ground.
Yeah, true enough, true enough. And I wonder how much you mentioned, like, the stuff in the 80s is not faring as well as the new build. And for context, for people who don't know, the 80s was kind of the Mike Milliken, bond-driven cheap market where money, for certainly one of the earlier times in my own recent history, became super cheap, super easily available. And like whatever we saw in the 2000 to 2004 single family housing market, like that loose lending standard that we all remember, like that's what occurred during the 80s. So I can only imagine that there was some slip shot, hurry up, throw it up, get that refi and keep it moving. Like, eesh, yeah, I don't think I want to touch any of the 80s product either.
Yeah. And then that's the difference, right? The standard of building in certain areas, and to your point, just bang it up, bang it up, bang it up. And if you ever go to a Texas multifamily, some of them are built in the hallways. They're not air conditioned, or they're not conditioned spaces, and they keep them open to, for the heat, but also now it's come full circle with the winter. The hallways don't, they're not closed off to the elements. So again, things that you think are suited for certain climates, but as things change, it's just like, well, that was dumb, wasn't it? We should have put doors on there. We should have conditioned the space.
Yeah, true enough. True enough.
Yeah.
So do you have a history or a background at all? I thought I saw somewhere on your profile that you were in hotel construction originally. Is that?
No, my background's in structural engineering. I built a lot of product across the globe. I worked in London on the 2012 Olympic Games back in 2008. I built stuff in New York. I built stuff in LA. I built stuff over in Australia. That's my background. So I do come at this with a different lens than the average investor, understanding what things, the building codes, and how to be compliant with building codes. And, I mentioned the frost line before, like 4 feet below the ground in New York is like where you got to put your foundations, because that's where the frost line is. So little things like that you pick up along the way. And then as you go from state to state, different climates, you notice things like, when you're in Hawaii, you don't have the same type of construction as you do in Boston. You know what I mean? So it's just for the different climates. But as those climates change, yeah, you sort of think, oh, I should have built it a little bit different. It's too late. So
Coulda, woulda, coulda. Yeah.
Exactly.
I'm always like, it's like a whole nother layer to the Reed Goossens story to hear the structural engineering piece. And I look at like my own background, like one of my earliest tools, or I guess toys, was like tools. My dad was an electrician, so I had like a screwdriver and a hammer and like wire strippers, and I would like wire up outlets for fun at like 5 or 6 years old. Not live electricity, but growing up on the job site, the construction site, I had about 1.5 years of mechanical engineering, and it's, I take it for granted, but I can kind of see the different layers of house renovations, and I've got this like visual mind. I can hand draw my own blueprints when I need to. So I can look at plans or prints, to some level, and kind of know what I'm looking at, or just a level of design. I'm not an architect, but certainly if you're flipping houses, or if you're building or doing new development, a lot of the creativity, a lot of the layout, a lot of the strategy of the build comes from the mind of the person who's kind of directing the operation. It's not the
Yep.
contractor who designs a kitchen. It's not even all the way. Like an architect, you can't just hand over the piece of land and say, okay, draw it. You actually have a lot of input and a lot of decisions as, the developer and the captain of the ship when you're building, or even when you're renovating or turning units over. You got to be the one making the decisions. And like the person who's operating the deals, the background, it's very telling for me, and I'm sure you too, because you have a podcast. It's very telling if you spot these like, histories of people who came up and are now doing what we're doing, whether that's multifamily investment syndications or whether that's, real estate single family or building $1 million homes. But it's very telling to see the history that leads up to the current moment. So let's shift gears real quick here. Tell me about your most exciting or most challenging deal since we talked in 2018. So in the last 2, 3 years, what's the one that you're like, either you lost the most sleep about this one, or maybe you were the most excited, this thing finally went to settlement, or we finally got our certificate of occupancy after all this work. Which deal is that, Reed?
That's a good question. Look, I'm pretty excited to say that we're getting the two assets we're selling right now. They've been great deals for us, very good deals, but have also been. I'm excited to see to go full circle, right? You don't ever trust yourself until you've got that run on the board, if that makes sense. You're being tested against, or what's your track record? Well, I've got all these deals and I'm paying preferred returns and I'm hitting all the, okay, well, but have you exited? Well, no, I haven't. And that's sort of been like, so I'm excited about that. I'm excited to show the investors who put trust in us to invest alongside of us that we're a good steward of their money. We've taken it seriously. Even to this day, I don't take a salary on my business. I eat when we close deals, and the money from asset management actually goes to keep the lights on. In terms of paying asset managers and analysts and keeping office space. So I'm very still much an entrepreneur in that I eat what I kill, but I also take very seriously my job of making sure people have trusted. I am of the younger generation. I don't have gray hair. And people trusted me with their money, and I'm glad that I can return it with a smile on my face and know that I've given it my all, and they've got a good return on top of it. That sort of sends, it's what we've got in this business to do. So I don't know if that answers your question, but that's sort of what's sort of not keeping me up at night, but that's what is making me most excited right now, because I know from there the snowball is hurtling down the hill, because it's going to pick up more and more momentum, because people want to start investing again. They're going to talk to their friends, and it's just going to keep getting more and more traction. So that's pretty exciting for me.
Yeah, it is. And congratulations for the exits must look like the finish line of a marathon. And I can relate in a shorter timeline. So when we're
Right.
flipping a house, right, we're borrowing 100, 200, 300,000, whatever it is. We're doing 40, 50, $60,000, $100,000 worth of construction, whatever it is. And we don't have the along the way cash flow. So it's not just a long-term thing. It's a complete speculative investment. And all the house flippers are nodding their head. Yeah, of course. Real estate investors. But man, it's like, I don't know, even to this day, we did 283 houses in 2020. We've done like 30 or something.
Wow.
Like certain ones I don't sweat at all. Certain
Mm-hmm.
ones I'm like feeling the pressure at all times. And we've owned them. We've owned one that's going to close for like a year and a half. We had a
Wow.
lawsuit. Everything
Yep.
went wrong. We're going to lose
Yep.
like $100,000 on this
Yep.
thing. And like, to see that one get to the finish line and then gone, and like even early on in my career, where it was like those first couple flips, it's like it felt like an eternity to go 3 months of construction,
Mm-hmm.
month and a half on the market. I mean, I'm a motivated seller by the time that thing comes around, and like the first offer, hey, take it, come on, it's sold. It's like 6 days on market, but I can relate to that, and then kind of seeing the exit, and I think that's probably why I personally don't do the syndications and put together, my own apartment deals. And like, I gravitate toward owning that, like a building I told you about, the smaller portfolio on my own, because I don't have the pressure that's applied by having the investors who entrusted me with the money on those. So there's no need for me to sell it. I can kind of sort of leave it out of sight, out of mind, and I can, sell it if I need to or not sell it, but there's no pressure for me operating and owning, my own personal portfolio like I just heard you describe. It's like these investors are kind of looking for the money. You know what I mean? So it's a
Well,
certain amount of freedom, but maybe I don't got the upside there as well, you know?
look, you're saying all the right stuff. Like but that's the point of going and doing other people's, using other people's money, is to grow my own nest egg to eventually one day have a 200, 300 unit property by myself. Right. But I also know that being a steward of other people's money, I am more on top of than it would be if it was my own deal. You know what I mean?
True
Like,
enough.
like if it was just Reed Goossens' own 200 deal, yeah, someone, it's operating where it's some other people's money. I'm like, no, I need to know everything that's going on, because I've got 150 investors who are sweating on me, making sure that I do my job as I say I was going to do. So it helps you rise to the occasion and helps you up level your game. And something that I, very grateful to have this experience. And in the beginning, it was very daunting to take on money like that. But over time, you build that track record, you build that trust, you build that transparency, and things will go wrong, right? You mentioned a lawsuit. I remember flipping my first house, and my dad was my investor, and I lost a bunch of money because I had to make him whole, and I had to give him a return on his money, right? I had issues with my GC as well. We just had COVID. We had to tell investors through COVID, we're going to have to pause distributions. Like, the market will throw issues at you every single time. It's making sure that you're down, you got your feet on the ground, and your investors know that you have their back, and you can do everything in your power to make sure that you can navigate these uncertain times. And that's exactly what we do. And you can't sweat that, oh, I wish I could have done this better. Or sorry, I wish COVID didn't happen, or I wish the snow didn't happen. It's like, that's what happens. Like, things are going to, excuse my language, shit's going to happen, and you have to navigate through it. That's your job. And that's your job as a syndicator, to make sure that you are steering the ship in the right direction. And I can stand here today to say that we have come through COVID pretty much, knock on wood, unscathed. There's a little bit of delinquency issues, but that was the biggest sort of stripes on my shoulder, is coming through COVID, as good as we have done. And that's a credit to my team. That's a credit to everyone who's pulled forward. And we've had some issues throughout it, don't get me wrong. But it helps you put the hairs on your chest, and, helps you know that you've got the mindset to push through uncertain times and challenging times, to come out the other side and not lose people's money. So, yeah.
Yeah, it's ironic that you describe it that way. I mean, it's, oh yeah, things are going to come up in any market. No, Reed, there was not much that came up from 2012 to like 2019. Like, it was so flat in the stock market. There was like no major issues. There was no like, the mortgage crisis was very media driven, and a lot of people lost their homes. But the uncertainty that came along with COVID was this like unique, holy crap, like I might even catch this thing and die. Like, this is it was like really uncertain. And like, thank God it didn't. I mean, at least there are a lot of people who have lost their life, and it is a serious thing with COVID.
Yes.
But a larger amount of the country was stable enough to continue paying their rent. That's something I didn't anticipate. I thought, oh my gosh, like, I am glad I did not do the apartment syndication thing now. Like, man, I'm looking, and like, I had the same issue that you described. Like, there were a couple of people who didn't pay the rent, and I was very proactive with my management company about trying to work out some things. And there's maybe a couple who are like, still are about to catch up with their tax return. They found some other work, and I'm happy to say I mean, we had a couple deals we bought where we sort of had some squatter issues, but most of the people took cash for keys to leave. They just abandoned the rental on their own. We have one out of all the deals in all the markets we do. We have one deal literally where they're like squatters' rights, professional tenant, and we're like probably going to fight them for another 9 or 10 months. But like, that's not bad out of a couple hundred houses that we've been in the process of,
And I'll add to that is, like, it's also 2008 was very American issue, right? It was very US issue. COVID is a global issue, right? There's rent due in Australia, there's rent due in Mexico, there's rent due in Europe, there's rent due in, Kenya. Like, it's due all over the world, and people have lost their jobs all over the world. So we're all in the same boat. It wasn't just specifically related to America, which then trickled around the world, which happened in 2008. So that is another level set playing field that you sort of have to also understand, that you're not in the victim mentality of, oh God, poor us, like, or poor me. It's like, no, this is happening around the world, and we've got to just get up, dust our knees off and do the best we can. And yeah, you're going to have issues with some tenants. You're going to make sure you're going to have you want to keep their best interest at heart, because a lot of people lost their jobs, not from any faults of their own, but from the fact that the place is shut down. Like, and you sort of have to come with a little bit of sympathy, coupled with, the lessons learned from 2008. Stimulus checks were a lot more quicker this time around than they were last time around. So that also helps, and that also gives confidence in the market. And then you've got other things like, multifamily. Yes, renters. Some renters have become professional squatters, but compare that to retail, or compare that to hotel or hospitality. Multifamily on the commercial side is looking pretty darn good, and is fared a lot better than some other places that haven't even opened yet. So like overall, and that goes back to the point we were saying earlier, is the compression in cap rates and why things are so frothy is because of how well multifamily in general has sailed through COVID. Because everyone, to your point, everyone thought, oh gosh, as we did in Lender March, all right, here it comes. We're going to have 50% of our 2,500 units just not pay. Like, we're calling the banks, get ready, saddle up. And it didn't happen, again, which is good. So I go back to just, not being the pity party, understanding it's a global issue, and trying to sort of lead with people first mentality. And I think that, for us at least, we came through relatively unscathed, and I'm proud to look back and say, yeah, we did come through, and we earned our stripes for it. So yeah.
Yeah, I mean, and we're talking about money. Money's a renewable resource. Like, a lot of people lost their lives here. A lot of people lost family
100%.
members. I mean,
Yes.
it's
They
like,
couldn't be there at their funeral.
unbelievable.
Someone goes off to the hospital,
Yeah.
and they're dying. It's like, sorry, you can't come in. Like, that's just, it's shattering. It's crushing. It's soul crushing. So yeah, exactly.
Yeah. So let's shift gears again. I thought I saw your Instagram post, and there was new construction going on there. I thought it was a Texas deal, and you had mentioned entitling land. So, like, entitling land and doing zoning, I would imagine, from people who taught me the business, there were people who would describe putting a piece of land under contract, taking it through the entitlement process, and then selling the contract, the package deal on the flip side, and making like a nice chunk of money. And they probably have $100,000 in soft costs there, attorney fees, architects, etc. So it's not a zero risk kind of a proposition. I'm curious, have you done some entitlement of land? Have you built some new construction with multifamily? What did the process look like in the specifics of that deal, where you had to like add capital and begin taking layers of risk
Yes.
to get it done?
So my background in structural engineering, I actually quit engineering in 2012 and moved over to the development side. And there's a picture, if you can see back just underneath here, is the first deal I ever built I was an owner's rep for a developer here in Los Angeles, but that was my job, entitling dirt for this developer and building high-end multifamily in Long Beach, California. So I had a lot of experience with that. The specific deal you're talking about on Instagram, which I think was called the Monroe, we actually had to walk away from that deal. We were going to come. It was an OZ deal, and we were going to step in. Opportunity zone, for those people who don't know what OZ means, step in as a developer. So we had to sort of come in before the end of that value was added, so we could get the OZ gains. And COVID hit, right? And we wanted to buy it at $217K a door. It was a brand new wrap product deal. We thought we had it all boxed in, and then COVID hit, and lease up risk went from a 24-month issue to a 12-month issue to a 24-month issue, which changed the returns completely. And looking back on it, we should have just probably done the deal, because at $217K a door, I know where construction costs are going today, and you won't be able to build it for $217K a door anymore. 3 miles from downtown Austin, in an OZ, an opportunity zone. Like, again, Andrew and I, my business, but we lost 250 G's on that deal.
Wow.
Okay. But a lesson learned, and we did the right thing by investors and say, look, we can't promise you the same returns we thought we were going to promise you. Things have changed. Insurance has gone up. Taxes have gone up. Leasing has changed. And through our due diligence, we've decided to walk away. Hard pill to swallow. But again, we've come out the other side, and we've done the right thing by investors, and it was our dollars at risk. Back to your original question, About entitling, yeah, the entitlement game is really, really challenging because you're at whim of the city, right? And when you're doing large scale projects, they can take 12 months, 24 months, 36 months, depending if you're doing a zoning change. And that can cost you holding costs, particularly if you're trying to get debt on the dirt. And you've got to sponsor or support all the soft costs. So actually soft costs can be quite expensive. You're getting architects through planning and then through public comment and then through the entitlement stage and then through, you have all these consultants to feed. So when you're not earning cash flow from that, you better have a lot of money in your bank to keep it afloat. Now, some cities are better at approving and quicker than approving, but it just depends on where you want to build. So the for rent product in Austin, Texas can take 2 years to get approved in the city of Austin. It takes a long time. It's like Los Angeles. It's like New York. It takes a long time. And you have to understand that. But a lot of people make a ton of money just entitling dirt, and they do it smart by only going hard with their money until they've got the planning commission on board. And that's sort of the 50% of the total nut along the way. So once you don't have any money up front, you've got, and you just get through the planning commission, and then you go hard with your money on the dirt, and then you've taken a lot of risk off the table. I know a lot of people who do that, and then they just turn around and sell the dirt back to another developer because they've taken, the risk is out of the deal for them at that point. They're just going to go to get to a shovel-ready permit, and they're off to the races. So it depends. It's horses for courses. It's how much risk you want to, how close to the sun do you want to fly? And really, if you can understand navigating your local municipality, because that's the key. That was my job for my developer in Long Beach, was navigating the city effectively through all the red tape to get a 200 or 300 unit podium style project, out of the ground. And it takes some time. So, yeah.
What kind of money do you think, if you had to guess? I mean, obviously, I'm not going to say, "Hey, Reed, you're hired," but like the soft costs on a 200 or 300 unit development entitlement piece with the architect, zoning attorney, the whole thing to get it to the point
I
of the
think
shovel-ready permit.
even if I was comparing it to, say, I'm talking tier one markets, I'm talking Austin. And Austin's now tier one market. If I was doing a downtown Austin project, it would be similar to LA. I think you're looking at least $1.5 million, like in terms
Wow.
of, like that's all your fees as well to apply, the application fees to apply for zoning. The city ain't looking at it for free. They're going to say, yeah, but we'll look at it, cough up $200,000, and then you got $200,000 an architect, you got $400,000 a civil engineer, like all these, and this is to get all the way through from schematic design all the way through to design development, which is a level of project and construction documentation. That's a level of details in your drawings that you need to show local municipalities to say, yes, we think you aren't a Yahoo and going to build some wacky job, and you say what you're going to do, and here's your drawings to prove it. That's essentially what you're pleading your case, and that can take 12 months. It can take 3 years. So again, depends on when you get caught up in the process. So over that period of 3 years, 2 or 3 years, or it could take between $1 million and $1.5 million for a 300 unit project, for sure.
Yeah, it's wild. I mean, I did the same small little building. It was an 8 unit when I bought it. It was 10 units. 2 were illegal. I had to go through the Chicago zoning process. Luckily, I had an attorney who was really solid, well known. And there was like this kind of handshake thing with the aldermen that they all, the lawyers. So they were all plugged in. It was a very political process. That went my way. And then after that, it was a zoning board of appeals for the parking issue. Like one thing after another, I did not realize how much work I was going to have to go through. I wouldn't have built the extra 2 units. It's just like, I haven't even broken ground on the 2 units yet. But it was interesting. The attorney who represented me represented another developer who's doing the Treasure Island grocery store. I don't know his name here in Chicago, but it was like a $65 million development, 90, 100 units, something like that. And
wow.
His sounded a lot more exciting. And said, "Well, how much would that be?" And he's like, "Yeah, I mean, you might spend, 150, 200,000 just in the attorney. Like we didn't have the architect there." But it was a very it has been and still is. I think my permit is issued yesterday. I paid for the fee. And, yeah, thank you. We'll see about building those extra couple of units, but it's a process that I think has value in certain type of deals at some point. It's not like I'm going to go off and be the the entitlement guy. We're very successful in single family, but
you've learnt the process, that the ropes that you're describing just there. And I, for anyone listening out there who wants to do entitlements, do exactly what you do. Start small. Like find a a single family lot that you can put a duplex on, and just go through the process of putting an extra unit on there. Like, just start really, really small. And you want to start with what's called by right. So it's zoned, your single family lot might be, you by right, by the law, you can add an extra dwelling on it, and you don't have to go through the hoops of zoning change. When you're changing a zone, that is when it just like, oh gosh, that can take you 3 years depending on the municipality. So yeah, it's exciting stuff.
Yeah, it really was. Are there any books that listeners or I could check out that have to do with entitlement, development, or anything
Yeah,
like
like
that? Or
I have not come across a lot. It's purely through just education, because again, each city is different, right? Each city has a political sway and how they want their urban core to look, and are they investing in their urban core? Do they want to attract developers? Do they not want to attract developers? So it really, really does come down to get the people that you just mentioned before, those politically connected, not politicians, lawyers, and a lot of local architects. Talk to them. The thing that I actually found really interesting here in the United States, I can walk into Los Angeles City Council, and if I've got a piece of land, I can go up to the counter before COVID and ask them questions like, "Hey, I'm thinking about doing, a 3-unit on here. Can you give me just your 2 cents on can I even do this legally?" And they will more than happily give you some their advice. In Australia, that wouldn't happen at all. So there are some ways. I know they do that in New York as well. So, and I've done some stuff in Philly that I'm pretty sure you can sort of have a chat with one of the local planning planners that can say, yeah, I think you can do that. It's in line with what we want to build, and it's in line with the zoning, and there's no conditions on that piece of land to say that you can't build a certain height over 85 feet or whatever it is. So all these things go into it, and it's what's called a specific plan for a certain municipality, and most municipalities will have what's called a specific plan of how they want their city to grow, but that is very dictated, influenced by the politics behind it. So there is no just book to say this is how you entitle dirt, because it's different in Chicago, it's different in LA, it's different in New York, because the zoning is all different. It's got different classes, and how you jump from one zone to another is also really, really difficult. And here in California, we have the Coastal Commission. Like, so if you're within 100 feet of the beach, you've got to go through another layer of Coastal Commission for environmental purposes. So there's just different layers there that you can't just say in one handy little book, here you go.
Gotcha. Yeah, that makes sense. And so you mentioned they won't do that in Australia. And if people did not figure that out from the previous episode that we did, where we talked about your background, but you also have the Invest in the U.S. podcast, right? And so
Right.
your perspective coming from halfway around the world, and with this kind of global thing, you run that show. And
Yep.
I am curious, right? Little plug for the show. People can go check it out there. You
Thank
have
you.
a bit of a business format, so it's like investing in some other businesses might be some of the topic, not just investing in US real estate. At least that were a couple of the topics I saw. But I'm curious,
That's
what
right.
were the biggest revelations, highlights, surprises, things that you learned from guests on your own show that you're like, wow, this is great, I'm glad I was the host of the show to even have this conversation?
Well, as being a podcast host, I started this thing investing in the US 5 years ago. I'm coming to 250 episodes, so one a week. But the thing is, it's like when I started the show, it was just about the benefits of investing here in US real estate. And after doing so many episodes, you can only talk so much about real estate. There's only so many topics before it just, oh, I've heard the tax advice, we've heard this, we've heard that, So I changed the name just to Just Investing in the US. And because there's so many other awesome founders and entrepreneurs who are here, who are creating incredible companies. And I think the real big eye opener for me is the ecosystem within a business. So, and when I say business, it could be a single family flipper like yourself. But you've built the construction management, you've built the property management, you've built it all in-house, and that feeds off one another. And that's really what I think starts to create wealth for entrepreneurs, particularly real estate investors. On my side of the fence as well, with the multi side, there's obviously buying multi, which is great because it's a business in itself, but you could have the property management. If you have 1,000 units or 2,000 units, yeah, maybe go start a property management company. You can make a bit of money out of that. Go start a construction management company. Maybe I was looking at a lot of people are starting to build these internet packages on site, and they're property owners. They own 10,000 units because they can do it on their guinea pig is their own portfolio. So the things that I've learned is that talking to other smart people who are way smarter than I am is just the different ways that you can, build Humpty Dumpty back together again. It's so many people have different takes on it. And that's what I think has been the cool thing about jumping on podcasts. And you can hear the energy that I bring, that I try to bring at least, is that I really get my juices flow when I'm talking to other people on that same wavelength, because sometimes entrepreneurship can be a little lonely. And that's what's been the greatest thing that's come out of my show is opening doors to people like yourself, mate, like talking to other incredible people who are out doing awesome things, and I get to hear their story and I get to share in the experience and the journey along the way. So I don't know if that answered the question, but it's sort of, it's a holistic approach of how I've really enjoyed the podcast. And I actually don't make any money off my podcast, because I just do it because it opens doors. And the doors that it's opened over the last 5 years, I can't put an ROI on that. The investors that I've been introduced to, I'm sure you're in the same boat. Would you agree?
Yeah, absolutely. I mean, for me, even the conversations themselves with a variety of guests who may not even remotely look like it's some kind of a match to single family house flipping, there's takeaways from that. I think it was, if I'm not mistaken, the fast food industry stole the drive-through from a bank, I believe is how the
Interesting.
story went down. So it was like, here's this, restaurant owner, and he like looks at the bank and they have the drive-through, and then he puts it into the drive-through window and like, bang, all of a sudden this defines fast food. So I'm
Interesting.
always kind of looking out for the drive-through window type of an
Mm.
idea. So whether it's the psychology of the investor of a multifamily syndication operator, or even the passive investor in that syndication, there's something in the conversation where they think that might apply for me. And it's like, I don't know. I've had, I don't know, 183 of these conversations, and like it's all right there for someone to go through, and like literally you could just like see how the conversation developed over the years, it's the same. We don't make any money from the podcast, and I don't even do it for, and like we've got investors who participate in our deals single family, but we don't really have like a whole lot of that going on. We're kind of self-funded at this point on almost all the projects that we have. We're in a really good position, but the knowledge, I couldn't put a price on the ideas. The drive-through windows that I've
Mm.
put into my
I love
business,
that.
there's no way that I could put a price on that,
I love that. It's nearly like a mentor, right? It acts as a
Mhm.
mentor to me, and you keep learning and you keep being curious. And I think that's the challenging part that I love doing this podcast. So yeah.
Absolutely, absolutely. So any trends or forecasts on what's coming down the pike? It could be product, it could be something about the economy, but like if you look in your crystal ball, Reed, what do you see?
I see. Look, I think not interest rates. Insurance is definitely going to go through the roof. I think it's continuing to go up and up and up. Cap rates are going to probably stay where they are until the Fed starts increasing rates. I do think the short term is that the Feds are going to keep it relatively low as we come out of this pandemic, because they want to keep stimulating the economy. So I don't think it's going to be a Band-Aid ripped off that we're going to go up, 25 basis points every quarter for the next 2 years. I think it's going to be a slow and steady increase over the next 2 or 3 years. But for me personally, like when money's cheap, cap rates are low. I do think we'll come back to, cap rates will start to expand again. And I think you'll need to underwrite from the multifamily side an expansion in your cap rates upon exit. But I think then also looking at other costs, the insurance costs are really going to play a massive role in how we go about buying deals. And I think global warming will have a massive impact on us as multifamily investors and our portfolios, and how we can afford to underwrite. I remember going to Texas, 6-7 years ago, and underwriting deals at $250 a door for insurance. It's now $500 a door.
Mm.
And I know that's cheap compared to some of the coastal markets, but that's only happened in the last 5 or 6 years. What's going to happen in another 5 or 6 years? It's going to go up even more. So property taxes are going up in Texas. So all these things means that my P&L keeps getting squeezed, and I need to be smarter. How do I go out and adapt? Okay, what does the city need? Well, the city needs affordable housing. Well, maybe I can go get some tax credits by doing some affordable housing stuff. Let's start having a conversation around that. So it's thinking a little bit differently. But overall, I do think it ain't getting any cheaper doing multifamily in this day and age. So I think the secret's out, and every man and their dog seem to be in multifamily right now.
Yeah, and I wonder how long it's felt like that. It's like,
Yeah.
my parents thought the taxes were much higher from 10 years ago before that. It was just like an unbearable trend. Any final words of wisdom as we get to the wrap up here on the show?
No, mate. I think the other thing would probably just be watch out for inflation. I think there's going to be a little bit of that coming around the corner with all this lending, quantitative easing. So there will be some inflationary effects that will impact us as real estate investors. So, but that only means that having your money in hard assets is only the better for that. So we're in the right space to be in.
Yeah, absolutely. I mean, I guess that's the saving grace, the rising interest, insurance, maybe the rising interest coming down, the lower cap rates, but perhaps the inflation in the rent is what ends up kind of keeping this thing moving as it always has,
Exactly.
right?
Exactly.
Do you want to point listeners who want to get some more Reed Goosens to a
Sure.
website, contact info,
Yep.
anything like that?
Yeah. Just simply go to reedgoossens.com. That's reedgoossens.com. I have to spell it out because I've got a lot of double E's, double O's, double S's. And just hit me up there. There's podcasters up there. If you are coming through LA and you want to meet up for a beer or coffee or lunch and talk shop, you can just drop me a line at info. That's info at reedgoossens.com.
All right, cool. Hey, thanks again for coming back to the show. I had a blast. I got a ton of notes here on the desk. So thank you for coming on the show, Reed.
Mate, my pleasure. Be well and stay warm, as they say now saying in Texas.
Yeah, true enough, huh?